S&P Global's U.S. Services PMI coming in at 51.7, ticking down to a 3-month low in March, still remaining above the 50 mark, signaling a rise in business activity for the 14th consecutive month. Joining us now, we have Chris Williamson, S&P Global Market Intelligence Chief Business Economist and Executive Director. Thank you so much for joining us this morning. I was saying that it's kind of a pick your poison when it comes to the data. What data have we heard so far this week that you think is going to be at the top of Jay Powell's mind as he comes and gives these remarks in a little over 2 hours here?
Good morning. Yeah, there's a mixed bag, really. I think the key message from what we've seen with the recent releases, including the ISM data just out and the S&P Global Services PMI, is that the first quarter certainly looks like it was robust growth. These numbers from the activity side cooling a little, but still consistent with an economy that's growing at least a 2% annualized rate. And as we saw from ADP as well, generating some decent jobs growth. Certainly that labor market not cooling especially rapidly. And I think that's where the focus is going to lie, that labor market and the pay data especially. Now, the ISM data and the SP data today showed this diverging pattern in price trends. Now, ISM, the price index there cooling quite markedly. In contrast, the S&P Global PMI showed accelerating price pressures in services. Now, that latter is much more influenced by wages. ISM is much more materials focused, and that explains that divergence probably. So what you've got here is this persistent wage pressures with this tight labor market. Just look at those ISM data. You've got very strong new orders growth and activity growth, but falling employment. This is because firms just can't get those staff, so they're having to pay them more. So that's going to be the area of concern, that labor market. The Fed's still going to want to see that the signs of that labor market cooling, and hopefully we'll see that at the end of this week with those updated wage data.
Chris, how much more tricky then does that make the Fed's job? That when we talk about the last mile and taming inflation, trying to get it under control, if we talk about some of the pressure that we are seeing, this move to the upside within wages, obviously a labor market that remains very tight, how much do you think that could potentially delay the Fed's first rate cut?
Well, we still think June looks the most likely. You've got a few more inflation prints before then to give them some confidence that inflation is coming down quite nicely. And by then it should be around the 2% mark, that headline inflation rate. But the question, that's base effects bringing that down as well. And if you look at the month-on-month rates, certainly with the survey data that we've got, it's suggestive that you're going to see some stickiness come back into the numbers. So we're running at levels that are sort of around 3% inflation mark going into the second half of next year. So that's going to really make for an interesting discussion as to whether June is the month where we'll see the first cut. We still think that's on. We still think the headline numbers are going to come down sufficiently to generate that. And then hopefully by then the labor market will be starting to cool, the wage data in particular, as those headline inflation numbers bring down the wage bargaining power for new pay deals, and that feeds through to this softer labor market picture from an inflation perspective, allowing another 2 rate cuts in the second half of the year. That still looks on track for this. There's nothing here that we've seen today, especially that's not that off track.
Chris, what does the Fed care more about right now? The non-farm payrolls numbers we're going to get on Friday, or the CPI print that we're going to get next week?
I would argue it's the CPI prints, because it wants those to come down nicely because of that wage bargaining effect. The wage data, you got the payrolls data that we're seeing for March. Remember, it's a lagging indicator. And what we want to see at the moment now is those headline inflation rates and come down so that unions and workers can't point to high headline inflation and say, look, we want this and a bit more. As soon as that headline inflation rate comes down to target, then those wage bargaining pressures are much more comfortable for the Fed to deal with. So I would argue that CPI we want to come down and see some definite signs that is settling around the 2% mark for the Fed to be comfortable.
Chris, given the fact that the Fed, it sounds like, well, what they have said and what you're saying, they need to be a little bit more convinced that inflation is going to continue that trend lower. What's your assessment right now about a risk of a recession and the ability that the economy is going to be able to remain so resilient if we are in this higher for longer environment?
Well, I mean, it's looking resilient at the moment, isn't it? The strength of growth in the fourth quarter surprise. First quarter looks like it's going to be a good one as well. It looks like companies are able to deal with this higher interest environment for now. It's been aided, of course, by the stock market gains we've had and those loosening financial conditions. Don't forget that markets have already, in effect, helped the Fed with some loosening of financial conditions. Just look at mortgage rates, for example, compared to where we were late last year. So you've got some loosening of financial conditions helping to drive this growth. The interesting thing, of course, is that if we do see some further repricing of forward interest rates, what's that going to do to those financial conditions and the markets in particular, and how's that going to affect business confidence? What we've seen so far is that there is resilience there, and this is in effect analysts saying, look, if you look at earnings growth, it can survive in this sort of interest rate environment for the time being. So everything looks okay as long as you've still got this promise of some rate cuts to come through later in the year.
Chris, everything looks okay until it doesn't, right? And so I'm really curious about how the Fed has been able to sort of hold on to its narrative for so long, given that we have seen this continued growth and resilience in our economy. I'm curious from your perspective, what data point do you think could chip away at the Fed, and particularly Jay Powell's commentary that there will be cuts at some point this year?
Well, what could deter them from hiking is, of course, from cutting is, of course, further hikes in the earnings growth, the employee earnings growth, and the CPI, and indeed, some of the data that we've got suggest that that is going to be sticky. Now, that could deter them from June. You could get to the May inflation print, and they're saying, look, the wage data is still looking a bit too buoyant. Inflation is not coming down quite as fast as we thought, especially the core, and so we just need to push it back, and that's obviously going to upset the markets, and that could cause some disruption there. But at the moment, that doesn't seem to be anything like the base scenario that we've got here. Certainly, there's no guarantee that you've got a June as a cut, but it's still looking very likely. And as I say, there's nothing in these data to really erode that view.
All right, Chris Williamson, great to get your perspective and insight, especially on a day like today. Thanks so much for taking the time to join us. S&P Global Market Intelligence Chief Business Economist and Executive Director. Thanks.